Hello and welcome everyone. This is Sarah Snell Cook, your host here at the Credit Union Connection. I'm joined today live by Richard Garabedian. He has done some of the conversions of credit unions to mutual savings banks back in the 2000s when that was happening. And he's with us to talk about the dereg proposal that NCUA has put out regarding the disclosures on mutual savings bank conversions primarily, but also with the mergers as well. Talk about why this was so controversial back in the day and it's not now, and much, much more. So let's connect with Richard. Hello and welcome everyone. I am Sarah Snell Cook, your host here at the Credit Union Connection. I'm joined today by Richard Garabedian. Welcome.
Thank you. It's nice to join you.
Yeah, it's great having you. Now, Richard is with the law firm of Fenimore K. Harrison LLP. Why don't you tell us a little bit more about yourself and your background?
I've been working with credit unions and banks for probably close to 45 years and perform regulatory guidance, mergers and acquisitions, capital raise, enforcement actions, essentially just about everything that a credit union would need from outside counsel. I don't do litigation, but as I just mentioned, just about everything else that would be of use to a credit union, both federal and state credit unions I work with around the country.
Yeah, which is why I reached out to you because I remember from back in the day, back in the early 2000s, when it was the hot trend, not really a trend, I think it was a little more than a dozen credit unions converted to mutual savings banks.
Correct.
And now which was a huge deal back then, and we'll get to that part. But, and maybe that'll be the first question, but now the NCUA has this dereg project it's doing and cutting back some of the regulations that came out of that trend that happened in the early 2000s. First, Richard, because I know you were around, why do you think this seems so much less controversial a topic now than it did in 2005, say?
That's a good question, actually. I think that credit unions may have become more accustomed to the concept, even though there's not a lot of strong interest, and don't look at it as a way of being motivated by the own self-interest of the directors and the officers of the credit union, but looking at it as a strategic option if it ever presents itself. So I think the real concern that existed 20 years ago is mitigated, and people in the credit union industry don't look at it the same way. In fact, many credit unions have acquired banks, so they're looking for that bank expertise in the ranks of the management of the target and also commercial lenders. Acquiring the bank doesn't give them any more uh, expanded statutory powers, but it'll bring them new locations and also commercial lending staff, which in many cases that's what they're looking for. So I don't think it's as perhaps controversial as it once was, but there hasn't been a charter conversion attempted and completed probably in a dozen years. And I believe that was Harbor One in Boston, who was ultimately acquired by Eastern Savings Bank about a year ago.
And that an Eastern Savings Bank is a commercial bank, correct? Not a mutual savings bank.
I believe it might be a Massachusetts chartered savings bank, yes, but I don't think it's a commercial bank. But it might
Okay.
be, but that really doesn't make much of a difference with regard to its powers.
It makes a difference in how the executives and or board members of that former credit union are compensated, correct?
Well, yeah, that's because if you're comparing a credit union with a bank, federal credit union directors don't get paid board fees. There's about a dozen states that allow state chartered credit unions to pay board fees. But if you're on the savings bank side or commercial bank side, board members can get paid board fees.
The executives often get a package for that acquisition too, correct?
When you say the acquisition, you mean
The former credit union executives.
I always advise my credit unions when they were converting not to propose anything that made it appear that it was being done for insider benefits. Credit union directors and officers didn't realize any personal benefit from the conversion itself. They never did.
There were certainly some back then that were, and we talked about this a little bit earlier, were more about making it money and a little less conscientious about it, about the conversion.
I can't speak personally to that because I really didn't encounter that in connection with my clients, but there could have been a few out there that recognize that if they became a mutual savings bank, they could convert to a stock savings bank at some period of time and get the benefits of being a stock savings bank in the form of stock options, restricted stock, and an employee stock ownership plan. So that's true.
And beyond that, I'm just curious too, because you did mention earlier about the being able to increase business lending, things like that. Credit
Yeah,
unions have difficulty doing. What
correct.
are some of the benefits of converting? If you go a little more detail about a credit union versus a mutual savings bank versus a commercial bank.
You have greater commercial lending powers. You have the ability to access the capital markets. You have the ability to form a holding company to diversify, and you may not be subject to the same restrictions in establishing branches because a credit union can only really go, in essence, where the membership can be generated, whereas with a bank, whether it's a commercial bank, savings bank, you don't have that same limitation.
Right.
But being able to raise real capital, as I will call it, is something you can do as a savings bank, whether it's mutual or the stock form. Whereas with
Mhm.
a credit union, you have to be a low income credit union to raise secondary capital, which is authorized by the Federal Credit Union Act, but it's not equity capital, it's debt,
Right.
but it counts
Right.
as capital under the Federal Credit Union Act. So there was an obligation, obviously, to repay it. There were many credit unions that were issuing secondary capital before interest rates went up. It's less attractive now because of the increase in rates. But if rates drop, which is anybody's guess, in the next few years, you may see more credit unions trying to access secondary capital, which has its own set of restrictions about being repaid in 5 years or so,
Mhm.
etc. And it is, of course, debt, so you've got to satisfy the debt service requirement. If you're raising capital by issuing stock, there's no obligation to pay dividends, but many banks do, just like many companies do. So
Mhm.
so there's not really a cost to it per se. There is with the subordinated debt that credit unions issue,
Mhm.
and it's only for low income credit unions. But there's probably a couple thousand low income credit unions. It's not that
Mhm.
difficult to qualify as such. So the access to capital is a real advantage.
Absolutely. And that capital is, of course, used for new technology, more services, more whatever the members
Correct.
or customers want.
That's correct. Yeah. But
It helps.
there's only a few that are doing it now per year. I don't keep it running tab, but because of the interest rate changes, it's not as attractive as it once was. You
Yeah.
can't really issue it at 3.5%.
And then hold on to it for 5 to 10 years and you can't
Right.
possibly take it out. Yeah.
Yeah.
Yeah, definitely certain advantages to the conversion. And especially, I think one of the, I think it was a big response, at least to have a plan in your back pocket, if not actually convert, when the tax exemption gets under pressure. Because then why not? You have all the authorities, additional
Yeah.
authorities.
Yeah.
They're still going to pay
And
taxes anyway.
I think that pressure will ramp up in the coming years. I can't tell you exactly when, but what the Congress would look at is these very large credit unions, let's say those over 500 million, and not paying any federal income tax or state tax, and questioning whether it's a level playing field with community-sized banks, and why shouldn't they pay taxes just like many other companies. So I think it'll continue to be looked at, but I think it's a tough row to hoe to try to implement anything in the next maybe couple years. Interesting to note that back in the early 1950s, mutual savings banks were not subject to federal income tax.
Yes, true.
And I think the Korean War and the economic pressure that put on, Congress looked around to see what might be additional sources of revenue for the federal government. With the kind of deficit we have now, I
Yeah.
see people thinking about additional sources of revenue for the Treasury Department. Yeah.
And I think that's a different tax level for the mutual savings banks. Is it different than a commercial bank, if I remember correctly? Like a subchapter T, I want to say. I don't know.
I don't know off the top of my head, but in general, I think banks are taxed at the same rate as ordinary corporations.
Right. And you make a good point about the mutual savings banks and the SNLs back in the day that were regulated by the Office of Thrift Supervision. And with the controversy going on around the NCUA board, as far as having one member or the relieving of the other two board members from their positions, and should it be a directorship versus a board, and should it be its own agency at all? Because the OTS also went away. So it's a little, to me, it's a little eerily similar
Yeah,
situation.
no, you're exactly right. And there's only one board member now, and that's Kyle Huffman, and he's the chairman, and he's moving over to Peekaboo,
Yep.
which is the organization that oversees accounting firms, which I thought was a very interesting transition. Although I did note he does have an MBA and he did spend time up on the Hill, I think, on the
Mhm.
banking committees. The new proposed chairman, his name escapes me at the moment.
Crew.
What was that?
I think his name is Crew. Last name's Crew, I want to say. I have to look that up. Shoot. Anyway, go on.
Yeah, no, it might be. So the two of the board members that were dismissed have, I think, filed a suit to get back on the board. Do you really need a three-member board? Not necessarily. The controller of the currency is one, the controller of the currency. But the interesting thing, not to stretch this point too long, but the old Office of Thrift Supervision reported to the controller of the currency,
Mhm.
and the controller of the currency is a division, so to speak, of the Treasury Department, whereas the NCUA has no oversight other than Congress, which basically means there is no oversight because trying to corral Congress to do anything is a Herculean task. We'll have to see how it plays out in the future, but I don't see a problem with having one board member personally. Now, the
Mhm.
FDIC has five, but depending on who that board member is, it could be good or bad for the industry.
Exactly.
We're lucky.
Yes.
We're lucky over the last 25 years, 5 years or so, beginning with Dennis Dollar, that the NCUA has gained more respect and recognition, I think. Now, how that will fare going forward, I don't know. I'm not sure what triggered the regulatory relief initiatives that the NCUA has put out with regards to conversions to savings banks or dealing with mergers. But when you look at it, it really doesn't do a lot. I think it's more just a PR move, so to speak, on the part of the agency to say, hey, we're trying to reduce regulatory burden. But the interesting aspect about the regulation that currently exists is that, in my opinion, and I have quite substantial support for this, that regulation violates the Federal Credit Union Act.
Explain.
Because the Federal Credit Union Act says that the conversion process shall, and I'm quoting here, shall be subject to regulation that is no more or less restrictive than is applicable to charter conversions by other financial institutions. And the NCUA regulation goes way beyond that, way beyond that. And you could say, Mr. Garabedian, how do you know that? It's because I helped write the statute. Okay. And there is no written legislative history behind Section 1785B2, where the conversion rules reside. There is no written legislative history. I wish there was. So the only legislative history resides in the mind of Richard Garabedian.
That is a high price commodity right there.
There you go. I think the NCUA, God bless it, put in the regulation to try to do what they thought was best for credit unions. And I think some of it smacks of just trying to prevent conversions because there's a number of provisions that clearly are beyond what would apply to a state bank trying to convert to a national bank or vice versa. It goes way beyond that. I don't know exactly whether that was enough in there to prevent credit unions from thinking about it because of the requirements contained in the reg and the manner in which the NCAA which we would review a proposal. Because Harbor One was the last one that went through the process and it was 12 years ago,
Yeah,
probably.
no, it's definitely died down.
Yeah,
But I think during that time period too, when it was a little more popular and controversial, it was the reason those regs were put in place. Now, just to cite a couple of the changes that are, as you said, small, I agree, but they're
right,
also can be significant. I think one of the changes is to ensure the disclosures are clear, quote, clear and conspicuous, but removes the definition of what clear and conspicuous is. And
right.
if you're looking, it should be clear and conspicuous what clear and conspicuous is, I think, because having that guideline in there, and I know some of the things you're talking about, there's literally font sizes and things like that, but that's
Yeah.
because people were writing in 3-point font or hieroglyphics back then. And having a definition sure is a safe harbor, I feel like, if you're going to be looking at this.
I
And
would agree.
yeah, and there are a couple things that peeved me so just because I feel too, they're one of the other big ones is to remove the prescriptive requirements for member disclosure statements and also to provide context. You had to provide a narrative around how you came to that conclusion that how you found the bank that you were gonna, or how you decided to convert, excuse me, to a bank, and all those things, the context around it disclosed to the members as well.
Yeah.
Again, trying to prevent people from taking advantage of that,
And
taking
that's
member money basically with them in their pockets, literally.
it. We can chat about that in a second. But
That would take another half hour.
being someone who's written many prospectuses and merger proxy statements for banks over the years, you want to have good disclosure. And in any kind of bank merger document, you're going to find it as to why the board considered a particular transaction to be in the best interest of shareholders in that case. But good disclosure requires that the document tell the owners, whether they be members, whether they be shareholders, why the board is proposing the particular transaction. There's no
Mhm.
question that ought to be done. And of course, the innumerable ones that I worked on, they said that. But you're correct. There might be some cases where the management doesn't want to emphasize that and tries to cloud the picture, so to speak, with regard to the ownership, whether they be members or whether they be shareholders. You want to have good disclosure. With the
Mhm.
SEC, you've got that agency overlooking the proxy statements, the prospectus, etc. With the credit unions, you've got the NCUA looking at it, who I would argue would have that authority, so to speak, even without something in the regulation to that effect. But
Mhm.
that's good disclosure to tell the reader what they're voting on and what for the
Mhm.
transaction. Absolutely. Yes,
And yeah,
absolutely.
that's what bothers me about this change too, because eliminating the plain language requirement is it's that's not reg to me it's in part yes reg relief, but it's also majority part not good disclosure. Basically, if you're not speaking plain language, you don't need a degree like yours and a history like yours to be able to read it.
No, and I would agree. And I'm not sure what prompted the NCUA to propose these changes or the ones dealing with mergers. I don't
Mm,
know what triggered it. I've tried to find out through my sources, but I've never been able to find an answer to that. I don't
yeah,
know.
same here.
Yeah, I don't know what triggered it. I don't
And
know
it's
whether the agency is feeling pressure from someplace to streamline and provide less burdensome regulation. I don't know. I just
obviously, there's the executive order requiring regulatory relief, basically where you can find it.
Sure.
Obviously, this is as there's, but I don't know, a dozen packages at this point of reg relief in the initiative, which is great. Most of it, I think, is great.
Yeah.
There are comment letters on this particular change that say we were supported overall, but not this. And in the past, I think, and this is where the politics and the executive order kind of part comes in, is in the past, the agency, as you I think you may have alluded to earlier, it was about self-preservation too. The
Yes.
NCUA wanted to continue existing, and credit unions want it to continue existing. But given the talk of consolidating agencies, given the talk of deregulation, cutting down costs, streamlining the government,
Yeah.
seems like this NCUA doesn't care to continue to exist. And because you brought what flagged it in my mind, you brought the merger to dereg, which is also similar to this one,
Yeah.
mutual savings bank,
Yeah.
very
Yeah.
similar. It's like, here, let's make it easier to get out of the credit union charter versus we want to keep you in.
Typically, a credit union merger involves another credit union. There have been very few mergers of credit unions into banks. The NCUA, under its plenary authority, adopted a reg dealing with mergers into banks and could exercise broad rule writing with regard to that, unlike the conversion to a savings bank, which has standards built into the federal law. There aren't any standards necessarily built into the Credit Union Act when it deals with mergers into banks. And the merger into bank regulation raises a number of questions as to how it would actually work when you read the regulation, because mergers of financial institutions don't follow the kind of concepts that are in the NCUA regulation.
Yeah,
Number one, announcing you're going to do it. You don't see that. Banks never announce they're going to do it until they sign a definitive agreement, because
right.
otherwise you'd have a complete Donnybrook of offers coming in from all over the place with regard to the target institution. And I'll give you an example, but I got to go back 25, 30 years. Back that far back, quite often the target or the banks in a merger announced a letter which is not
Hmm.
a binding merger agreement, and that
Right.
caused all sorts of disclosure issues with the SEC, etc. So now the institutions go directly to a definitive agreement, and that's what's announced in the press.
Okay.
The NCUA is ignoring that and saying you either have to hold an auction for the target credit union, or you have to make this announcement that you're going to do it. Not
Hmm.
practice. It's never been challenged and it's never really been implemented in any meaningful way to flush out the issues it would cause. It's it's not, in my opinion, thought out.
I totally get what you're saying. I think just then it's inherent in the ownership structure, though, that you would have to announce it so that your members would know because they're
Well,
the owner. I mean,
your members would know once a definitive agreement is signed. It's not that the members need to know that you're thinking about it, because with other important material matters, the institution doesn't announce, hey, we're going to do X, Y, and Z, because they don't want the word to get out and have it scuttle their intentions.
right.
The fact that the members need to know doesn't mean you have to tell them before you sign a binding agreement.
Okay. Interesting.
Yeah,
Um,
absolutely.
no, this has been a really great discussion. I appreciate you coming on here, Richard. And so I always allow my guests to have a final thought. What would you like to leave our credit union audience with today?
It's interesting. I did have a conversation with a former board member, I'm not going to disclose the name, who did a really good job in his position as such. And he was not a proponent of having a rule that exists like currently exists with regard to charter conversions, because in his view, credit unions need to have a choice. That's what I'd like to leave the audience with. You want to have a meaningful choice that either because of economics or other reasons, or just dealing with a regulator that doesn't understand your business, you should have a meaningful choice. And having your hands tied, so to speak, with the current regulation really diminishes that possibility.
All righty. I said I'd give you the last word. I'm giving you the last word. I'm zipping my lips.
Okay, that's fine.
I'm not going to respond. Thank you very much. I do appreciate it, Richard.
Thank you for the opportunity. If anybody has follow-up questions, I'm happy to respond.